All right. Welcome, everybody, to this live session at Phenomena. We're going to be talking about the all-weather strategies. But before we get started, I hope everybody had an amazing Songkran holiday. I know it was a long holiday for many people. I stayed home with my mom here in beautiful Bangkok and did a lot of writing. In fact, I wrote a lot over the last 4 days of holiday. But I'm glad to be back. Of course, the markets are crazy these days, and Donald Trump is very unpredictable. And we're going to be talking about that. And I'm going to be talking about some research that we've done and looking at some academic research related to good days, bad days, you know, how to think about how to handle a portfolio through the ups and downs of the market. And that's definitely what we're going through right now, is a lot of ups and downs. Turning on my air conditioning, it's a little hot in here. So welcome, everybody. Make sure you say hi and prepare your questions. There should be a lot of questions today because things are going nuts in the market, and I know we all have questions for that. So let me get started. I'm going to bring up my presentation and talk about it a little bit. So let me do that. And we're going to be reviewing the past month. Now it's April 21st. So though we're reviewing March, we're trying to update the data as of recently, as of Friday, I think. So remember to ask your questions in the chat. I love your questions. Keep them coming. Oh, by the way, let's meet in Bangkok in person. If we haven't met, feel free to come out tomorrow at my event that's called Build a Business That Lasts. I can't wait for this one. It's really something I've spent about 20 or 30 hours on preparing for this 3-hour presentation tomorrow. So, and I think we do have a discount for you by saying that you're coming from Phenomena. So remember, our allocations are global, long-term, and diversified. And also remember why we're here. We're here to build wealth over the long term. And I see 6 pillars of investing. First, invest in stocks. Stocks have generally outperformed bonds and gold, offering a share in the value created by company management. That's what I love about stocks. Number 2, reduce risk. Diversify your portfolio across companies, sectors, countries, and asset classes to minimize overexposure to any one area. That's what we do in the all-weather strategies. Number 3, contribute regularly. Reduce stress with dollar cost averaging, which reduces the emotional risk of investing by enforcing discipline. Number 4, stay invested. I know it's a roller coaster right now, but think long-term. Be patient. The benefit of compounding happens over decades. You've got to wait. Number 5, maintain discipline. Follow your investment plan to avoid acting based on emotions. And number 6, continue learning. Enhance your investing skills by staying informed and learning from successes and failures. We create our strategies for many decades. However, not even a decade is long term. This is me when I was young. That's me when I came to Thailand. And that's going to be me when I'm 100. I just met someone, a student of mine that I hadn't seen in about 10 years. And they said, you look exactly the same. I hope that remains. Our aim is to create strategies that perform over many decades. I outline most of this in my book, How to Start Building Your Wealth Investing in the Stock Market, which is available in both English and Thai, and also through my online course at academy.astotz.com. Our target is to deliver steady returns over the long run. All-weather strategy launched in February 2019, and we targeted 6% per annum. All-weather Alpha Focus launched in October of 2021, and we targeted 8% per annum. And All-Weather Inflation Guard launched in July of 2022, and we target 4% per annum. Now, from when we started All-Weather Inflation Guard in July of 2022, the strategies are performing almost as expected. Recent rankings show higher risk All-Weather Alpha Focus has had slightly higher return, while low volatility Inflation Guard delivered the lowest return, but the lowest risk. Again, look at that green line. It's a very stable line and a stable rise. Now, since July of 2022, all strategies have had lower volatility than world equity. We mix asset classes to reduce equity drawdowns, though this also limits gains during market booms. As you can see, we tend to eliminate the worst of the drawdown, but we also miss the best of the tops. So before I get into that, let me go back and encourage you to ask any questions. Let's see if we can get me up on the stage. Hold on. Feel free to ask any questions. Let's see if we can, there we are. Okay. I pressed the wrong button. So feel free to ask any questions if you've got questions. I do see some people in there. Sati, nice to see you. Little Hamster X, hello. Little Hamster X, that's a good one. Chui Gin Thai, I'm not sure what that one is. Greetings from Thailand. Peng, greetings from Bangkok. Yep. Sawadee krap. Tarinrat. Welcome to everybody. And feel free to share your questions, any questions that you may have. I've just done the beginning part of my presentation. And before I go into it any further, I'm going to have a little sip of espresso. So what are you drinking? Are you drinking espresso? Coffee? Matcha tea? I'm drinking a Coffee Works espresso, and it's fantastic. So I appreciate that you come and spend this time with me on a Monday, and it's 1 o'clock here in beautiful Bangkok. And this time is for you, right? This time is for you to see about the performance, what's happening, what's working, what's not, and ask any questions, right? So here's a question from Taratep. What are the chances that the US dollar Thai baht rate will be 1 to 30? In other words, 30 baht for a US dollar. I think it's very possible that the US dollar could be losing value and the baht strengthening. I think it's possible. Right now, I'm not sure if it's going to come right away, but I do think that's possible. So let's get into the presentation again. I'm going to go back into it, and hold on 1 second. Okay. So unfortunately, all of our strategies lost money in March. Now, the performance that I'm presenting is as of the 15th of April. It's been a tough time for the markets. Let's first look at all-weather strategy. All-weather strategy is already pretty defensive at 65% equity, 25% bonds, and 5% in gold and commodities. And here we can see that since inception, the strategy was up 43.8%. That's 21.2% above a 60-40 portfolio. So unfortunately, we lost just like the market. We lost 3.6% in the past month as of 15th of April, but we've widened the performance gap to 21.2 from 19.8 in February, meaning we outperformed in the down market. Now, nobody likes to lose money or see their portfolio fall, but if we can fall less than the overall market, that is the number one measure I'm looking at for all of our strategies. And so I really want you to focus in on how do we make sure, whether it's your own personal portfolio or this portfolio, how do we make sure that the downside is not so painful? Now, in the past month, the strategy was down 3.6%, which was 0.1% below the 60-40 portfolio. Our 25% allocations to global bonds in China were down, but outperformed the world. So our 25% allocation to developed Europe underperformed. Still think that there's opportunity there, but we're going to have to see. Remember, we're investing for a 3-month period, and then we'll see where things land. Now, the strategy has added about 1.9% value compared to the 60-40 portfolio year to date 2025, and that is after fees, or our best estimates of fees. And over the period of time, we've had the outperformance of 21.1. The strategy beat a 60-40 portfolio by 7% in 2024. Next, let's talk about all-weather alpha focus, which lost less than all-weather strategy. Now, remember that all-weather alpha focus is a higher risk strategy. So to lose less is pretty impressive. And I'd say we did well. So we're 68% bond or equity. Bonds are 13 and gold's 19%. This is actually relatively a low level of weighting in equity. We can go up to about 90, 95 for all-weather alpha focus. So we're actually quite defensive. And here we can see that since inception, the strategy was up 3.4%. And that's 11.1% above a 60-40 portfolio. Now, we lost 3%, as I mentioned before, in the past month as of 15th of April. But we have widened the performance gap to 11.1 from 7.6 in February 2025. In other words, we went down less. And here we can see that we've gone to 4.7% above world equity from 2.4, with a lot less volatility. That's our objective here, is to provide you with long-term exposure to global equity with a little bit less risk. Here we can see the all-weather alpha focus. The strategy was down 3%, which was 0.7% above the 60-40 portfolio. Our big tilt to gold did great, and our tilts to global bonds and infrastructure helped relative to stocks. Our tilt to healthcare underperformed, down about 6.1%. The strategy has added about 6.1% value compared to the 60-40 portfolio in 2025 year to date. And the strategy beat a 60-40 portfolio by 3.5% in 2024. And this is after our estimates of costs. Finally, let's look at the all-weather inflation guard, which was down 2.1%. Remember that this is the lower risk portfolio, and therefore it's reasonable that it was down 2.1. Equity is at 30%, bonds are at 60%, and gold is at 10% for this strategy. So since inception, the strategy was up 7.6% and 9.7% above a 40-60, meaning 40% equity. The strategy has also experienced less volatility. Now, we lost 2.1% in the past month as of the 15th of April, but we have widened the performance gap to 9.7 from 8.1 in February of 2025. In the past month, the strategy was down 2.1 and was 0.8% above the 40% equity, 60% bond portfolio. Our 10% allocation to gold did great, and bonds did better than stocks in March. Money market and tips outperformed global bonds also. Our 5% allocation to financials and infotech underperformed. That's pretty bad. The financials down 10%. But one of the things you can notice is that this strategy is so well diversified across more than just equity that even when equity's down 4.4 or financials, as an example, is down 10.4, it's still not going to kill this portfolio. So the strategy's added about 2.4% value compared to a 40% equity, 60% portfolio in 2025 year to date. And the strategy beat a 40-60 portfolio by about 1% in 2024. and you can see 9.7 from the beginning. This one is a lot harder to outperform with. Now, before I go into why staying investing is best in the long run, which is part of the research that I want to talk about, I want to welcome you to ask any questions that you may have. So feel free to ask any questions. Let's look at your questions. Here's a question from Peter Parker. Many people fear the market. They are brave enough to do the DCA only. So is it the right time to put a large sum in the current situation? Well, I think that's the key question, Peter. Now, I'm going to look at this in two ways. First, I'm going to look at it in terms of you investing in equity. And the second way I'm going to look at it is you investing in the all-weather strategies. So the first one is you investing in equity. One of the things I can say is that you, for investing in equity, it's very hard to time the market. And so it is good to try to look for times that you think the market's really cheap. And then if you think the market's really cheap, then yeah, put in more money. Maybe put in double the allocation you'd normally do with the dollar cost averaging. And when you see that the market is really expensive, you may decide to cut in half your dollar cost averaging contribution. I think that kind of adjustment is definitely possible. Will you be right? Very hard to say. I can tell you, even myself as an expert spending 24/7 thinking about this, that I'm not right many of the times that I make that call. So now the second part of this is if you're investing in all-weather strategy. If you're investing in all-weather strategy, I would say always be investing. Always be DCAing or adding more to it. And the reason is because I'm already trying to time the market to some extent by switching between stocks and bonds and commodities and gold. And so you don't want to get too fancy with timing the market with the all-weather strategy, or else we're both timing the market. And then that oftentimes doesn't lead to a great outcome. Now, hopefully that answers your question, Peter, but feel free to ask more detail or make a suggestion. As you say, many people are afraid at this point. All right. Kuna Tip says, is it time to invest in India? Not yet. Not yet. But maybe in another month or two. From my FEMR basis, I would say it's not time to invest in India. Let's go to the next one. Next one is Tony Channel. As we navigate through the current uncertainties, especially with the rising tension around the U.S. trade wall, I'd greatly appreciate your thoughts on how to balance our portfolio under the conditions. Well, I think, Tony Channel, the thing that I would say is be cool. What do I mean by be cool? Don't be a panic person. Don't be a person who freaks out. Be a person who diversifies and remains calm. Now, a lot of reason why people freak out is because they don't diversify. So, in fact, Saturday, I was just on the committee with all the other professors and graduates of Thammasat interviewing the incoming students. And one of the students was telling us how he'd been investing in the stock market, and he made a lot of money in the stock market, particularly the US stock market. And I asked him, how many stocks do you have? And he said, one. I just picked the best one. Well, anybody that knows anything about finance knows that that is a very risky thing to do, because if that stock goes down by 50% or 100%, you're in trouble. Now, I told him, hey, my research says you should probably own about 10. So I try to warn him. But the point is that many people get exposed to, let's say, 2 stocks, as an example, 3 stocks. And then they have problems with their portfolios. So basically, what I would say is be diversified and think long term, because even if you're short term, right, and you're more of a trader, your objective is the same. Your objective is to end up with the most amount of money at the end of the period. And so that's kind of my thoughts on that. I don't know if I've answered your question perfectly, but feel free to ask more. Let's continue on to the next question and keep up your questions. Feel free to ask more, and we'll take some more questions, and then I'll go back to the presentation and then feel free to ask more questions. So I try to read in Thai. It says, I think it says Shuikin Thai, but I don't know. So what do you think about gold? It has beaten S&P return, but will that last long? I don't think it will last long. I think eventually gold is going to run out of steam. In fact, as you saw, we reduced the portfolio's exposure to gold in the last rebalance. And so that is a real, that's where I'm at. Now, we still have gold in the Alpha Focus strategy, but we have taken it down to 5% in the all-weather strategy. So I would say, it's flying right now. I wouldn't necessarily bet against it, but at any moment, we have to remember that gold is a risky asset. It's not a safe haven asset when it comes to volatility. It can be just as volatile, just like crypto. When you see crypto go up, that's exciting. But the reality is that when crypto goes down, it can go down extremely hard. And if we see, for instance, interest rates come down in Europe, which they're coming down, and Trump getting his way and trying to bring down interest rates in the US, it could mean that bonds outperform, and that's part of the reason why we're in the bond portfolio. So that's my answer on that. Again, if you don't like my answer or you want to ask more, feel free to ask more. Okay, always summer. I love that. So, Sawadee Ka, Kun Andrew, Sawadee Ka. Okay, I'm an AWS port investor. I wonder if trading 20% of ES gold for ESEG-A was a good idea, as I saw 7.5 loss in ESEG since switching. Oh, it was bad. It was a bad idea. I think we have, we've suffered from that for sure, right? I wish that I didn't make that move up until now. However, remember, it's a long game. We don't rebalance until every 3 months. So we still have 2 more months to see where things go. And at that point, we'll consider rebalancing. Also, always summer, it's important to remember our goal. Remember what I started out with, that our goal is to build wealth over the long term. You're going to miss some, you're going to get some right, but ultimately over time, we have produced pretty good returns. And what I would say is that if you go back to 2019, when we started with Phenomena with the all-weather strategy, we made a lot of mistakes. We made a lot of investments that if we had only been in that, we would have done better. But you're not thinking about those right now because you have recency bias. It's happening right now that we're missing that opportunity. But the way I always like to think about this is to think there's about 10,000 investable stocks in the world. And every day, maybe 100 of them go up by 50%. We miss all of those. So we are always missing opportunities. And when it happens, I feel bad, but I know to stay the course and it will come back. We've done well over a long period of time. That's my answer to that. Gong says, do you suggest invest in all China, A share or H share? So right now we are in small cap and A shares. I think you're already getting the tech exposure that you get in H shares through US NASDAQ and the US market. So I wouldn't say that it makes sense right now to go on China H shares. Okay. I'm going to keep going, and then I'm going to come back. I want you guys to keep sending in your questions. If you didn't get the answer to your questions, then keep asking. I see questions coming in, and I'm going to come back to those in a second. So let me switch back to my presentation. Going to get a glass of water. All right. Let's see if we can get my presentation back up on the screen. I think maybe that one. Maybe. Okay, there we go. Give me a second. So this is how investing has recently felt. It's like a roller coaster. It feels out of control. Sometimes it's down, sometimes it's up. But for sure, it's bringing us a lot of emotions on this roller coaster. And this is what investing should feel more like. This is what we're going for. So how can we do that? Well, remember when I talked about our long-term strategy and the discipline to follow it. An investment framework forces discipline, and we follow ours with iron discipline. I am not worried or panicked when one asset class falls or another one rises. It's easy to be emotionally affected by market events, which can cause you to make rash and costly decisions. And to avoid this, we stick to our framework. The strategies rely on data and structure rather than just a feeling. Now, another key feature of our strategies is that we aim to lose less when equity markets fall. So here we have a chart of the return of the 10 worst returning days of global equity. So the all-weather strategy has lost less than 60-40 on 9 out of 10 of the worst days. Recently, the strategy lost more than a 60-40, which is very, very rare. But as you can see, we went down more in April 4th, but significantly less on April 3rd. That's interesting. So we had 2 days and we had different performance. So ever seen headlines like these? How Chinese stocks fall to earth? My hairdresser said it was a bull market. Why most traders lose money and why the market requires it. Or irrational investors are panic selling instead of buying cheap. Or the cost of succumbing to fear. Or small investors miss stock market rebound. There are many advocates of buy and hold. There's also a lot of evidence to support it being a sound long-term strategy. At the same time, many people are trying to time the market. When timing the market, you want to avoid the market when it's falling and be in it when it's rising. Ideally, you'd skip the worst days and catch the best. But of course, we know that's nearly impossible. Perfectly timing the market is something we'd all like to do, like this call on gold. But timing the market is nearly impossible and risks missing key days. And since no one can consistently predict the best and worst days, market timing adds the risk of being in or out of the market at the wrong time. Now, we did some academic style research where we looked at the impact on your terminal wealth, meaning your wealth at the end of your investment horizon. That could be 10 years, 20 years, 30 years from now. And we looked at missing the 10 worst days, in this case, in 10 years, and missing the 10 best days in 10 years, and why you could end up being in the market on the worst day and missing a best day. Now let's review what previous academic research has concluded. Let's do a little bit of a literature review. We have a paper by Sehun in 2003. If you can't time accurately, avoid it. Sehun studies the impact on returns from missing best and worst days and months using monthly U.S. stock returns between 1926 and 1993 and daily between 1963 to 1993. Now, because this research was done in 2003, the time horizon doesn't really include anything recent. Now, excluding the 12 best months reduced the terminal wealth by 86%, and avoiding the worst 12 months increased the terminal wealth by more than 12 times. Basically, what this tells you, if you missed just 12 days out of the whole period, you would have lost almost all of your gain. Now, also, Sehun found that missing the 10 best days reduced terminal wealth by 38%, and avoiding the 10 worst days increased it by 92%. So trying and failing to time the market is what is most likely to happen, and that's going to hurt you massively. And this research shows it. If you can't time accurately, avoid timing. Now let's look at Johnson and Kruger that wrote this research in 2004, where they'd say avoid market timing. They study dollar cost averaging and market timing on daily S&P 500 returns between 1982 and 2001. Missing the 10 best days decreases annual returns by 24%, and avoiding the 10 worst days enhances annual returns by 39%. Missing both the best and worst 10 days increases annual return by about 15%. So avoid market timing. Dollar cost averaging can help you to avoid this poor market timing. Let's move on to Estrada in 2009. Stick to buy and hold in the US. Estrada looked at Dow Jones Industrial Average between 1900 and 2006. So now we're getting a little bit closer to our time period. Missing the 10 best days would result in a 65% lower portfolio value, and missing the 10 worst days would result in a 206% higher portfolio value compared to a passive buy and hold strategy. The odds are stacked against market timing, as 10 days accounted for only 0.3% of the total days that you'd have to be thinking about buying or selling. So avoid market timing and stick to buy and hold, according to Estrada in 2009. Now, Estrada also extended his research to emerging markets and continued the study, but looked at 16 emerging markets and 110,000 daily returns. On average, missing the 10 best days would result in a 69% lower portfolio value, and missing the 10 worst days would result in a 337% higher portfolio value compared to a passive buy and hold strategy. Now, there's a lot more volatility in emerging markets, so it tends to have an exaggerated impact. But the main conclusion is the same: avoid market timing and stick to buy and hold. And Meb Faber, investor in 2011, came up with investors can time the market to some extent. He investigated the impact of missing the best and worst of the S&P 500 daily returns from 1928 to 2010. He shows that extreme daily returns have a significant impact on terminal wealth. And he found that 60 to 80% of the best and worst days occurred in declining markets, defined by being below the 200-day simple moving average. And he suggests that investors can time the market to some extent by being out in declining markets. In fact, the author of this one, Meb Faber, was on my show, My Worst Investment Ever. And he talks about avoid the physical pain of loss by sticking to your investment plan. You can find his podcast and his blog, and he's a fantastic guy. So let's look at this research. We did some research. We got global data. We gathered the time series of daily prices of the MSCI All Country World Index for the past 10 years. That's around 2,600 trading days as of the 9th of April, 2025. So we're going to update this research and put it into our own context. We randomly selected 10 days from the best or worst. In other words, why we randomly selected these days rather than taking the 10 best and the 10 worst is we thought it is extremely unlikely that you would ever be exposed to all the best and all the worst. So that really, to me, I did research on this before, and that to me seems to be unrealistic. So instead of doing it all the best and all the worst, what I did is I said, what's the chance that you could be out of one of or 10 of the best 100, 10 of the worst 200? And I randomly selected those. So we calculated the daily percent change and identified the 100 best and the 100 worst daily returns. And then we invested in the market, but removed 10 randomly selected days out of 100 best or worst days. Again, I did it this way because I think it's more realistic to what we're going to be exposed to. And we assumed 0% return on those 10 days because we took our money out of the market. We're not going to assume that we earn 1% at the bank or something like that. Let's not complicate it. We repeated this process 100 times and looked at the average, maximum and minimum terminal wealth. And we compared the outcome to a buy and hold strategy. So just to describe this, description of an investor's actions around a best and worst day. So here you can see in the middle is one randomly selected best or worst day. The closing price one day before and the closing price at the end of that day. So the investor sells his full position at this price, the closing price, and the investor fully reinvests at this price, the closing price at the end of day zero. So how much do you gain from being out of the market at the right time? What impact would missing the 10 worst return days in a 10-year period have on terminal wealth? Over the past 10 years, world equity has returned 80%. If you had invested 100 in world equity 10 years ago, your terminal wealth would be 180. Missing the 10 worst days, which is the green line, increased your total gain by 64%. If you missed the 10 worst days in the past 10 years, your gain would be 131 instead of 80. So how bad does it hurt to be out of the market at the wrong time? What impact would missing the 10 best days in a 10-year period have on terminal wealth? So here's our chart where we looked at missing the 10 best days, and what we saw here, in fact, sorry, I just got a little bit confused. This chart is showing the 10 best days as the blue line. And what we can see is that we eliminated 44% of the total gains. So if you miss the 10 worst days in the past 10 years, your gain would be 45 instead of 80. So now let's look at this chart to make sure that we understand it clearly. Let's compare missing the 10 best days and the 10 worst days in the past 10 years. And what we can see is that when we buy and hold, we get an 80% return. If we miss the 10 worst days, congratulations, we're up 131. And if we miss the 10 best days, we're down 45. Now remember, our numbers aren't as extreme because we're not talking about missing the 10 worst and the 10 best. We're talking about missing a random selection out of 100 of the 10 of the 100 worst and the 100 best. And if you can predict the 10 worst days and stay out of the market, do it, but you can't. That's not an easy task, and you don't want to miss the best days either. So next, we have a question. Why would an investor miss the 10 best days? Nobody would want to sell at the 10 best days. Well, when the market plunges one day, it's not uncommon that investors sell in panic, right? You may have felt that at times. So missing the best days is likely to occur as a consequence of panic selling on the worst day. But here we can see is that the 100 best days are clearly clustered with the 100 worst days. So panic selling is common at big downturns, the red dots. But due to clustering, your loss could grow as you risk being out of the market on the best day. So the market collapses, you're terrified, you sell out at the end of the day, but the next day the market bounces back. You've now missed the best day. So the key takeaways are missing only the 10 worst days over 10 years increases your terminal wealth significantly, but missing only 10 best days over 10 years seriously hurts your terminal wealth. And panic selling on the worst days can result in missing the best days as well, which we just saw because of the clustering. So unless you're a market timing wizard, you'll do best to stay invested over a long period of time. Now, before we get to Q&A, which I'm going to go through your questions and try to answer them as much as I can, I studied with the father of the quality movement when he was 92 and I was 24. His name was Dr. W. Edwards Deming. What drove Dr. Deming was his mission to help U.S. firms improve quality. He inspired me when I saw him teaching at the age of 92 to pursue my mission over the remaining 30 years of my career from now. I'm turning 60 in July. And that is to help mid-sized family businesses double profit in 12 months, guaranteed. So the next cohort of the Profit Bootcamp starts on May 5th. You can scan the QR code to see if you're eligible at theprofitbootcamp.com. I'd love to see you there. All right, it's Q&A time. Feel free to ask any questions. Let's go back to the presentation. All right. So what did you think about the 10 best, 10 worst days? There's a lot of analysis in that, but it's a fun thing to make sure that we understand. All right. So let's see what we got here. So let's look at your questions. Mask Solo says, is gold still interesting to buy or waiting for a dip? it's important to remember that gold is not an always appreciating asset, whereas stocks, companies generally are, because companies have a management team that are running the business and are trying to make adjustments for inflation and for other risks. And so the end result is that you get a long history of improvements. Gold is only going to go up and down based upon the attractiveness of gold. And right now, because of the uncertainty in the market, gold's attractiveness is very high. So I wouldn't say I would wait for a dip. I would say it's getting probably close to too late for gold. All right. Gritney says, DCA only gold and Bitcoin because I observe DXY and bond yield 10-year. What do you think? I just, because I'm not your advisor, I don't really know your personal situation. So I don't know. I always would say to people that for Bitcoin in particular, I wouldn't make it more than maybe, as I say, 0 to 3% of an overall portfolio. But, you know, some people are trading it a lot. So I don't think I can give you a great answer on Bitcoin there. I do think that we are likely to see that the 10-year bond yields will be falling in the US in the next month or so. And that should be a good sign for equity. All right, let's continue on. Little Hamster X says, so can still stay invested in the US, right? Or should reallocate to other assets? Well, if you look at, I'm going to go back to the presentation for just a second. Let me just go and find the allocations here. 1 second. So hopefully you can see my screen. Let's see if we can get my screen up here. And I'm going to do that this way. Here's a funny way of doing it. All right. And on this screen, actually, maybe I'll do it that way. Okay. On this screen, what you're going to see is the allocation to the US market right now is 5%. 5%. So we are deeply underweight the US market right now. And so Little Hamster, that gives you an idea of what we've done in the last move in the all-weather strategy. And so we already have allocated to other markets. Has that worked? Not necessarily, but it seems okay. All right. Now let's go to next question. What's your view on Thai stocks? Ka. Well, you know, stocks eventually bounce back. And I would say Thailand is in a terrible situation when it comes to the profitability of Thai companies. In fact, in May, I believe the SET will try to announce something called Jump Plus, where they're trying to encourage companies to be more capital efficient and to get higher profit margins. But I would say part of the reason why I started working with mid-sized family businesses to help them double profits is because Thai companies are struggling right now. So I do think that the Thai market eventually is attractive, but from a timing perspective, I haven't really looked at it that much because mainly I've been looking globally these days. But in the end, Thailand will come back, but it's going to come, basically, it's going to come by stopping the focus on ESG, which I think is just potentially wasting a lot of money of Thai shareholders, number one. Number two, it's going to come when companies make the shift from being a low-cost producer and into a higher value producer. And that's happening because of China putting a lot of pressure. It's hard to be a low-cost producer in Thailand. All right, Endgame. Can you analyze China, Hong Kong stocks, cheap but high risk? China, Hong Kong stocks definitely have a correlation with US tech. And so I like to look at it in relation to what's happening with US tech. But overall, the thing about Hong Kong is it's never really been cheap. Now, also with both China and Hong Kong, there's a heavy weight in banking sector. And banks are never expensive. They're never going to be, let's say, 15 times PE. They're always about 10 or even below. And that's what keeps the Chinese market down and the China H shares down a bit. But for right now, we're not building any position in China H or in this case, Hong Kong companies. Now, Surya says, according to reciprocal tariff, even all countries were negotiated with free trade agreements. Would you mind to share your opinion that this change in trading will impact investment in the long term? Well, I'm curious how this is going to work out. I'm just standing up at my desk here, so just let me move my my computer up. Just raising my desk. So I would say that reciprocal tariffs are a difficult one to figure out for any of us. But I suspect that what's going to happen is that think about if an American company wants to import wine into Thailand, if an Italian company wanted to import Ferraris into Thailand, what is the tax? It's big. And I suspect that what Trump is going to get out of this is countries like Thailand are going tariff levels to US goods. And when they do that, then I suspect that Trump will come off of the reciprocal tariffs. In the end, I would say his target is not really Thailand. His target is China. So I think over the long term, it's not going to have a huge impact on investing, because I think ultimately we'll get back to, and in fact, Syria could have a positive impact. And here's how. Let's just imagine that Trump is fighting with all these countries and he gets them to lower their tariffs. Even Europe has tariffs on US products. And he says, we're willing to lower US tariffs if you lower yours. We could end up in a situation where in a couple of years, we have a world with much lower tariffs. That would be the best outcome that would have an impact on the long term. All right, let's look at the next question. These are good questions today. Thank you. All right. How should investors manage their mindset when stock market faces a crisis? Don't look at it. When many years ago, I got rid of email, and I had a lady in the Philippines, and I still have a lady in the Philippines who takes care of my emails. She acts on my behalf with my emails because I have hundreds of them coming. And basically in the beginning, I gave the password. I had her change the password and give it to my best friend, and I couldn't access the emails. And that was the way I got myself off of emails. It's like an addiction. Market is like an addiction. You have to figure out a way to get yourself away from it. Now, it's very hard to get away from it if you're not diversified. Now, if you're investing following all-weather strategy, you're diversified. So you shouldn't be overwhelmed by what's happening in the market. And always remember, what goes up comes down, and what comes down goes up. So that would be some advice. ABB says, Sawadee, John Andrew. Well, nice to see you. And Rapunzel says hello. And what's the final destination for gold's price? You think I know? Do you think anybody knows? I don't think so. If I knew, I would be, in a very different situation. But I would say we may have a little bit further to go on gold, but eventually things will settle down in the markets and with interest rates and with Trump and with tariffs and with China. And eventually I think gold will come back down. All right. So here we can see all country world ex-US ETF. And that's a possibility for someone who's saying, I want to get rid of the US. And it's a good way to split up your exposure globally. You have US and non-US. Supercorn, good afternoon to you, Krap. So what are really Trump needs? Well, I think basically what Trump needs is China to sit down and talk to him. Of course, Trump doesn't understand anything about the history of China. And the thing about China is that for 5,000 years, all the countries around Asia come to China and kowtow to the Beijing government. And so it's very unlikely that China is going to go to Trump. They're going to have to come up with some way of a compromise. And with that compromise, China and the US will work something out. And so what's happened, I think that China's playing it smart in the sense that they're not publicly going to the US. You remember when Zelensky went to the US, he just gets embarrassed. There's no point in doing it out in public. And I think Putin's doing the same thing. He's not going to be drawn out into the public where he's standing there with Trump. So I think that Trump needs negotiations with these countries, and he needs them. Ultimately, in the case of China, he wants them to bring down any tariffs and any barriers. I mean, if you want to, as a Thai person or as a US person, you want to go set up a business in China, it's not easy. Thailand does a lot to try to make it easy, and it's still hard to do business. Okay, what's your view on Thai stocks? I think I already answered that one, so I'm going to skip that one. Supergon says, as US dollar seems continue soft, may a key reason to move gold up as well as US bonds, government bonds, impact from Trump policy. Those may factor to adjust allocation early. Supergon, you must know me by now. I have iron discipline. I will not adjust an allocation early. And there's no reason to do it early. Now, if this was, and I'm looking at potentially launching some strategies related to stocks this year, if it was a stock portfolio, I think that I know that with my stock strategies, I have stop losses in place. So with a stock, you can't think about it the same way you think about a diversified ETF and a diversified portfolio. If a stock goes down, it could go down to zero, and therefore I have stop losses. But I've back tested stop losses with our strategy, and it doesn't help. We are diversified enough that I'm willing to go 3 months and then look at it again. Hope that answers the question. In the view of fund managers, they will maintain developed market a certain number all time, but may move money, allow different markets, such as move from US to EU to Japan. Can you help give a view? I'm not, I think my view is expressed through my strategy, and where I am with US is I've taken some of that US money and I put it into EU right now, and I put it into China. I haven't moved my position into Japan yet. Maybe that will come in the next rebalance, but not right now. And remember, we were in Japan before we got out of it, and we had a great return in that investment. ABB says, what's happening? Investors sell all US access, dollars, stocks, bonds. What will trigger the next? Well, it's part of the reason why I'm 5% in the US market right now. Yeah, it seems scary, but things work themselves out. Things work themselves out. Which stage of economic cycle do you think we're in now? And ABB also said, can you name this coming recession? Yeah, exactly. Triple X shock. Wait, what? So to answer both of these questions, let's talk a little bit about the economy for a moment. So it's important to remember that the economy and the stock market have almost no correlation to each other. So be very careful when you think, oh, we're going into recession, because the stock market usually will anticipate that recession and make its adjustments. And I think that's part of what the stock market is doing right now, is they're concerned that rising prices and that the Fed may have to raise rates. That's a risk in the US, right? But raising rates isn't going to solve the problem in the US with tariffs. And so there's really no point in raising rates and slowing down the economy. So I would say that we probably already in a recession or getting close. In Thailand, it's been depressing, but in the world and in the US, we see some market downturn. But I think it's also important to remember that in the US, the mid-cap and small-size companies are already struggling. They've been struggling for the past 10 years. It's only the large cap and the tech companies that have been doing well. So we do run the risk in the US of sparking a recession from this. I'm not sure what to name it. From your model from Trump, did what are totally make change to market, and what are metrics we need to keep watching? Well, I think the next big thing is Trump's going to kick out Jerome Powell. And he's going to do that and basically put pressure on Jerome Powell to try to get them to reduce interest rates. And I think that that ultimately is likely to happen. And if we go into recession, it's going to happen anyways. And that's part of the reason why I also have this position from my model in bonds. So that hopefully gives a little bit of an answer. All right. Well, I think we went over a lot of things. You guys had a lot of questions, and I appreciate it. And feel free to keep asking those questions, and I'll be with you guys in a month. Let's see where the portfolio goes. At this point, we're going to sit and watch what happens. And then when we get to our next rebalance, then we'll do a rebalance. And hold on one second. What do you think of the US dollar Thai baht? Will US dollar appreciate further 6 months, 1 year? It's, we haven't had a huge move in the Thai baht relative to the dollar. I think right now we're at 33 or so. But I do think that at some point the dollar is going to weaken and the Thai baht as well as other currencies around the world are going to strengthen. But you have to be very careful about this because the US has so much power in this situation through military power, through stock market power, and through economic power, through banking power, and all of that. And so the point is that the US dollar could stay higher, stronger for longer. Just to let you know, we're going to rebalance the strategy in early June. This from Little Hamster X reminds me of that great song, When Will I See You Again? Well, tomorrow night, I'll see some of you guys. Hope to see you at the event that I'm doing tomorrow night, where I'm talking about building a business that lasts. And meanwhile, I want to thank all of you guys for attending and asking all of your questions, and also for supporting the all-weather strategy. I'll do everything I can to stay true and keep my iron discipline and stay focused on the long term. I'm not on a roller coaster, and I don't want you to be either. Thank you, everybody, and I'll see you in a month.